Hi, it's Brian Rose and Colin Powell from Silicon Reel. It's week 8. It's been a crazy adventure. We've met some of the coolest and most innovative people here in London's technology startup scene.
Yeah, it's been an incredible time, blowing away all my expectations, and I just can't wait to keep on doing it.
Yeah, it's crazy. It doesn't stop here in the studio. We go out to the Silicon Drinkabout, sponsored by the Three Beards. And about 2 weeks ago, we met the guys at Accenture, and they told us about the FinTech Innovation Lab. And it's this really exciting new program that's happening right now.
Yeah, and it's perfect location. One of the main themes really has been that London has a great opportunity to sort of rule the world in financial technology.
And they're accepting applications from all over the world for any idea you have in fintech. So you can apply up to September 8th. If you're selected, you have like a Dragon's Den style pitch day. Yeah. And from those people, they select another group and incubate them from January to March of next year. Everything finishes in one big pitch day with VCs there, bank CTOs. It's just an amazing program.
Yeah, the access really is the thing that blows me away. If you're running a fintech startup right now, you know how hard it is to get a hold of these guys. Could take you years. And here they are mentoring you for 3 months. So you really, really should get on the ball here and take advantage of this.
Yeah, I'm so excited to be partnering with these guys. We're going to follow the process for the next 7 months and see what gets produced. And I just think it's the same mentality as Silicon Reel, paying it forward and try to break down some of those innovators' dilemmas that we talk about every week on the show.
Yeah, really, that's the key. The only way the banks are going to improve is if they can get access to the people that are innovating, and this really breaks down that wall.
Yeah. So until then, we're going to keep bringing you excellent shows every week from the movers and the shakers, the winners and the losers of the London technology startup scene. And now we're going to leave you with Jeff Lynn, who created Seedrs, another fabulous financial technology story.
Yeah. Enjoy.
This is Silicon Reel, so now we're going to get real. Michael and I have a question about your business model, and so we're just going to hit you with it.
Let's hear it.
I had a question about your fees. You're very upfront about your fees, but they're not small.
Yep.
I think you charge 7.5% on the close of a deal, and I believe you charge 7.5% of the profits the investors make on an exit.
Exactly.
Am I right? And are those high or are those low in your opinion?
So you're absolutely right. Those are our two fees. I think they're very reasonable, and I think that the important bit of context I'll talk through both of them. But the 7.5% that we charge for the companies once they've raised capital takes into account a tremendous amount of work. For one thing, there are no legal fees involved, and depending on the size of deal you do, the average deal on our platform is £50,000. So that's £3,750 that a company's paying. Often they would pay that just in legal fees to close an investment, much less to actually get the investors and do all the other work involved.
I'm sure Sullivan and Cromwell charge more than that.
Well, not only does Sullivan and Cromwell charge more than that. I mean, even a lot of sort of local lawyers would charge several £1,000s, often £4,000 or £5,000, just to sort of get out of bed in order to do a deal. So compared to the other options out there, even just on a legal fee basis, we are often cheaper. But then add to that we're bringing you the capital. In many cases, you have to do a lot of work to generate interest in your campaign as well. It's not a passive experience, but you're getting access to all of this capital. And we do a lot of other things that even lawyers tend not to do. So we take care of your SEIS and EIS tax filings, and that makes a huge difference. It's one of those things that for us to do, because we have a standardized process, isn't a huge amount of work, but to do it on a one-off basis when you haven't ever done something like that before would be hours and hours of the entrepreneur's time. So we add a tremendous amount of value there. And I think the final bit to say there is that we are doing a lot of work on spec essentially up front. So deals that don't fund, we charge nothing to. We don't believe in pay to pitch. We think that requiring people to pay money just for the chance to raise capital and when they might not succeed is evil. So we do a lot to get people in the door and get them ready even when they haven't funded. And so on balance, we think that 7.5% is a very fair and reasonable price. In terms of the 7.5% carry that we take, so that comes from investors, so that the company pays nothing more, but the investors, if they make a profit off of an investment through sale of shares or dividends, we take 7.5% of their upside. What I would say to that is, look, if you were invested in a fund, you'd be paying 2 and 20. You'd be paying a 2% annual management fee and 20% of the carry. So you'd be 2% out of pocket every year, even if the thing did terribly. And then if it does well, you're out of pocket 20%.
So this is, people that don't know, if you invest in a hedge fund, say you invest $100,000 in a hedge fund, they will charge a 2% management fee and 20% of the ups, as they say, the upside of any investment.
Exactly.
And mutual funds would be less, but you're just saying it's not uncommon, this practice.
I mean, this is. I mean, I think the comparison to hedge funds and venture capital funds, which are also generally 2 and 20, is reasonable, because this is a private asset. I mean, mutual funds are different because you're dealing with a much lower cost of execution or a much lower cost of management. But investing in private asset classes does have a certain cost to it. And for us, we think that, granted, unlike a hedge fund, we're not making the investment decisions. We're giving the investors the power and the responsibility to make their own investment decisions. So to charge a full 2 and 20 to them, we think probably wouldn't be reasonable. But to charge what's effectively a 0% management fee and 7.5% of the ups, we think is a reasonable balance. And I think most importantly on both fees, we have talked a lot with entrepreneurs and investors, and we did so before setting the fees and after the fact. And everybody would love to get a discount, but by and large, people's views have been that they've been reasonable. And in particular, I think most important have been on the upfront fee, on the 7.5% of funds raised. While companies sometimes complain or ask about it before they fund, every single one that has gone through the process with us and seen everything that we do and seen how much value we add have said after the fact, oh, that's a very reasonable fee structure.
Okay, fair enough. I would say that 7.5% that the company pays, in a way the investors are paying since they own the company.
Yeah, well, absolutely. Look, money's fungible,
Right.
and in a sense, that's right. Although I think that the way we look at it is, more than anything, it's coming out of the founder's equity. So if for example, you've raised £100,000 for 10% of your company, really what you've done is raise £92,500 for 10% of your company, and instead of it being £1 million valuation for you, it's a £925,000 valuation. And so we tell people, we say, look, figure out how much money you need, and then you just need to raise a little bit more than that to cover the fees.